Welcome to the Armchair Trader, bringing you insight and analysis for the self-directed investor. In the studio today is myself, Stuart Fieldhouse, editor of the Armchair Trader. With me, my colleague, Michael Morton, and we also have Tony Cross, investment writer and regular contributor to the Armchair Trader. We'll proceed with having a quick look at the ISA season, which is coming up if you are a UK domiciled investor. If you're not, you may be wondering what we're talking about, but basically the ISA is the individual savings account, which is a tax-free investment vehicle for UK investors, which allows you to invest up to I think £22,000 now in a wide range of different assets, including shares and funds. And we have quite a in-depth listing of what we call self-select ISAs on the website. These are ISAs where you can actually choose what goes in them rather than having a third-party fund management company to manage it for you. So you are effectively picking and choosing your own investments to go into the ISA. And we've got quite a good list there of many of the leading providers of these types of structure, along with the fees. Investors have an allowance, that £22,000 allowance they have to use up by the end of March. So the reason why we call this the ISA season is because it's the time of year when people suddenly realise if they have some excess money, they need to invest it.
I think there's been a big change there, Stuart, in the last few years, though, as that allowance has gone up from just a few £1,000s to say north of 20,000 now. That historically, yes, you found a lot of people with £3,000 or £4,000 left at the end of the tax year wanting to get that salted away before they lost that allowance. And certainly work that I did with other ISA providers, 5-6 years ago, we saw that time and time again. But I do wonder to what extent the ISA season is now a bit of a misnomer. People aren't really going to run out of it, sadly, most of us aren't going to be able to exhaust a £22,000 allowance every year and be left to the last minute. But it certainly makes for a talking point.
There seems to be a wider range of investments you can put in a self-select ISA now, aren't there? Because before it used to be a specific UK listed shares and investment trusts and specific ISA eligible funds, but more recently it seems like they're becoming a little bit more liberal with others. For example, foreign shares, I think you can add into them now.
I'm not sure about foreign. I know you certainly had AIM stocks into them. That was a change that took place a few years ago, and was seen as something that was a great advantage to those smaller cap or those very small cap, typically very small cap stocks in terms of increasing demand for them. I think the government has to take a more liberal attitude here as well, because the reality is most of us probably aren't saving enough for retirement. So anything that we can do to incentivise people to get stuck in and give them what at the end of the day is, for a lot of people, a relatively minor tax break, because remember, you get the first, I think it's £2,000 at the minute of dividend income tax-free. That is falling, I believe, next tax year to £1,000. But there's still quite a nice buffer there for people that maybe haven't got a lot of money. You're going to have £15,000 invested typically to be getting £1,000 worth of dividend income from relatively high yielding stocks. So there is I think there's a nice initiative here in terms of getting people to build that rainy day fund by promoting the whole ISA concept.
I think it's quite interesting. I seen an article recently. Hargreaves Lansdown sent me an email about it a while ago, where some of their clients now, sort of having been putting in a full allocation into their PEP beforehand and now into their ISAs, have become ISA millionaires.
Really?
And we're getting to that point now where people, if they are able to max out, if you're fortunate enough to have enough money to max out your allowance, is setting you up for a nice, comfortable retirement.
Or setting you up to be the richest man in the graveyard.
Yeah. But it's 14 years, which is interesting.
And obviously, over 14, well, I think 14 years is the ISA lifetime, isn't it? The PEPs go back further than that.
Yes.
Because I say over 14 years, you're going to have to make some pretty smart bets to get to £1 million.
Yeah.
Even maxing out an allowance until a few years ago was just a few £1,000s. So yeah, I take the point, and yes, there are some people that have managed to get to that very impressive level of £1 million of savings, which is significant by anyone's metric.
Yeah, well, that's not me. That's,
And looking at the data that we've actually got on the website, there is quite one of the things that surprised me was there's quite a lot of variation in the fees in the self-select ISAs. There's a lot of competition, and certainly amongst the top 3 or 4, the brokerage fees you're getting there are actually very good if you're thinking of doing your active trading in your ISA. And certainly if you were thinking about trading liquid UK stocks and you're thinking of investing less than £22,000, it seems like a good first port of call. But then on the other end of the scale, the data shows that there are some fairly expensive offerings out there as well.
I think it's one of those cases though where you do get what you pay for. The bigger, lower cost brokers can come, unfortunately, with some pretty bad customer service. That's from my own experience. You're one in a vast pool. So whilst the pricing may look attractive, I think you've just got to be mindful of the fact that you do run the risk of if you have anything that is out of the ordinary. I'm running through a dispute at the minute with an ISA that I set up for one of my kids with one of the big brokers, and that isn't going anywhere quick. And for the amounts of money involved, it is slightly farcical. But so you have that situation where yes, you can do it, and in theory, there's going to be no difference if you're with a broker, whether you're doing that trading of stocks within the ISA or out with. Obviously, the other advantage you've got now is that you can trade out of an ISA position and reinvest the money in the same tax year, and it doesn't count against your allowance, whereas historically, I believe it used to count against the allowance. So once you'd invested £3,000, as it was, if you took that £3,000 out, you couldn't put it back into an ISA that tax year. You'd have to wait until the next tax year, whereas now you can go in and out. So you do have that ability to do the short-term trading in your ISA. Again, obviously be mindful of the costs, whilst the obviously the dividends are tax-free and there's no capital gains tax. You're still going to be paying stamp duty on the when you make every purchase, and you're still going to be paying the transaction fees for the broker.
That's very true. And on the subject of customer service, I found I have a self-select ISA, and I found when I made the decision to change ISA provider, it did turn into a very long and involved exercise, and obviously the incumbent was making it very difficult for me to actually do it, and I had several phone calls and emails going back and forth before I actually managed to effect the transfer.
I think there are moves afoot, though, aren't there, by the regulator, currently going through a review process to try and make this more frictionless, to allow people to move, and that obviously in turn will make the market potentially that bit more competitive. But of course, if people are using opening offers to lure people in, then I guess that's going to be a short-lived event, because you don't want the proverbial rate tart just jumping around from one broker to the next every year to save £50, where it's actually going to. This does come with a meaningful cost for the broker to handle the transfer.
Yes, and the custodian as well. I got the impression with my custodian is the institution that actually holds onto the shares for you and keeps them in your name. But it sounded to me with my movement of my ISA, there was a lot of toing and froing with the custodian bank as well. I don't think they're incentivized to be helpful at all with share transfers. Yes, all exciting stuff, but if you want to have a closer look at what's on the market in terms of the self-directed ISAs, then do make sure you check out the section on our website.
I'm putting together our best buys at the moment for 2019. It's interesting what you say, Tony, about the different costs and things involved. They are quite disparate between the brokers, and there are savings there to be had, but obviously service is one thing. Another thing I'm quite keen to sort of look into is if you go with sort of one of the larger brokers that maybe you pay a little bit extra in platform fees, are the costs, if you're going down the fund route, cheaper than if you're going for one of the guys that's that's cheaper for their platform fees. So it'll be interesting to see, but that'll be coming out in the next week or so.
Excellent. I shall look forward to that. Very good indeed.
So one thing that I guess would be quite interesting for people listening in as well is where to put your ISA funds for this year. Your £20,000, £22,000.
£22,000, yeah.
Where does it go this year?
Well, it's. I think this year is going to be a really interesting one if you're a UK investor, because you've got Brexit looming at the end of March, and sorry to bring that up on this podcast as well, but that could have a big impact on any local assets you might have and any local investments you have. People who already have a pension fund, be it a company pension fund or state pension fund, already have exposure to a lot of UK assets, just because those pension funds by definition will have a lot of sterling exposure. So with your ISA you may be wanting to look at investments that are not going to be as affected by Brexit, for example. Maybe, just taking an example here, but US or Japanese equities in a fund might be one possible solution.
I think that the challenge there, Stuart, is that with the pound so beaten down right now, if you start looking to invest overseas, you're potentially buying in at the wrong end of the market, because I think regardless of what happens on March 29th, there can't be much more downside, fingers crossed, for the pound from here. That there's going to be short-term volatility, but what we've seen repeatedly is sterling getting stuck against cable around about that 128 level. The market doesn't seem willing to push any lower, despite the mounting uncertainty, despite the emerging political risk. So the indication being that actually what's going to happen now is, and especially if we get a cordial Brexit, a soft Brexit, or let's tempt fate, maybe no Brexit at all, the pound's going to gain from here. That means anything that you've bought that's denominated in a foreign currency is going to depreciate in sterling terms. So for my money, I would be thinking those blue chip stocks that are denominated in sterling, that are earning most of their income from overseas, could prove a good bet. So again, you do have some exposure there if the pound appreciates, but not to the same extent as being in a pure play dollar or yen denominated stock.
So you're thinking here in terms of the resource companies,
resource stocks, or even some of the big services companies. People like Vodafone, they've got a lot of income coming in from Europe, from India. About 80% of profits in the FTSE 100 come from overseas. And I guess the other thing you need to bear in mind is, what are you investing for? Where are your liabilities going to be in the future? Yes, if you're looking long term to move overseas, then it probably makes sense to start, to make sure you're covering that base now. But if you're ultimately going to be, you're in the UK, you're going to retire in the UK, you're going to be in the UK eternally, then having those sterling denominated assets is going to make a lot of sense. So obviously there is the political risk, but we should probably consider that in a separate conversation. That's a big one to talk about.
That's an ongoing one, isn't it? It's quite interesting because looking at the stats on inflows and outflows of funds, it's only I've only seen data for December. at the moment, but a lot of money is coming out of the UK equities and going into global funds, likes of Fundsmith equity, Lindsay Train global equity, and those kind of things. So it's having said that, it was December, and it would be interesting to see where the money's moving as we close in on March.
I have no doubt that is a popular trend. I say my only caveat is the idea that if we do suddenly see a 10-15% appreciation in sterling, those investments are automatically going to be on the back foot. However, as always, it's a marathon, not a sprint. You should be looking at making these investments for the longer term in the vast majority of instances. And a relatively, yes, that's going to be a big hit, but 5 years down the line, you've got that geographic diversification, which again is really important to have. And it doesn't surprise me at all to learn that people have been reallocating assets even this late in the game. But really, the time to start doing it was probably in May 2016, not December 2018.
Absolutely right. Well, one other thing I've picked up that's quite interesting is that a lot of movement in money is sort of going into income funds rather than growth funds. So people sort of taking their dividends and possibly reinvesting and going for sort of high yield. So we're looking at sort of yields above 5% is a bit of a trend at the moment as well. Any merit in that, do you think?
Well, I'm no expert on those funds in particular, so I don't know what's going into them. But certainly from a pure equity perspective, I think you've got to be very careful at the minute in terms of chasing yield, because we're seeing some high yielding stocks where the share price has been beaten down significantly, and I think that is just one of those things to be mindful of. If you're looking at a stock purely on the dividend, just check back and see what's happened to the share price over the last 6 months or so, because if that's tanked, and there was one of the healthcare companies, I forget what it was, but where someone had been invested for a long time and the share price had gone up and up and up and up and up, and all of a sudden it had turned. The dividends being maintained, so the dividend yield's fantastic, but the actually no, it wasn't. It was BAT, British American Tobacco, and the share price had tanked, so the dividend yield's fantastic. But really, are they going to need to maintain that? I don't know, but just typically when you start seeing big dividend yields in the past, it's been a red flag for problems coming down the track.
It's twofold, isn't it? With a high dividend yield, there becomes pressure to maintain that, and obviously any reduction in dividend yield in the future is seen very negatively. The other side is the other side of the coin is whether the business is consistently performing well enough to be able to pay that high dividend. You'd think perhaps that the share price might sort of go up as a result, but it's getting the balance right between the two, I think.
Yeah.
And the other thing is, you've got to also bear in mind that the UK interest rates are still incredibly low, and some of that flow has got to be people looking for a better yield than they're getting from gilts, basically. There is money coming out of equities and looking for a new home, and sort of low risk government debt is not providing that yield. So that's why you're seeing cash flowing into, say, the peer-to-peer lending market, but also people prepared to take on a bit of extra risk with exposure, say, to corporate bonds, just because they want the income and they want to leave it there until they get an idea of where the global economy and indeed the UK economy is going at the moment.
Do you think that's sensible, Stuart, having exposure to corporate debt in what we could see move into a very rapid phase of interest rate increases in, say, 2020, 2021?
That's where the institutional money has been going, and there's been a lot of talk about how the interest rates are going to go up, and we've seen the Fed shy away from that, having bullishly said they were going to do something like 3 rate hikes, and this is when the rate hikes are going to be. And the White House started to complain about that, and now they've backed away from it. And we've seen the same with the Bank of England, started to raise rates, and then now the UK economy is not looking as healthy. We've got Brexit on the horizon, and the Bank of England's suddenly a lot more cautious. I think 6 months ago, it did look like we were heading for that.
Yeah.
Now I think central bankers, certainly in the US and Europe, are backing away from a tightening policy at the moment.
I absolutely agree with that assessment of how the central bankers are communicating the message. The risk to me is that not so much in continental Europe or in the Eurozone countries, but both the UK and the US face a risk of significant increases in inflation. In the UK, we've got Brexit, potentially going to be disruption in terms of pricing, potentially going to be tariffs applied to imports. So that's going to drive up the cost of goods, constraints in the labour market, going to drive up the cost of, employment. So we've got two factors there that are going to basically make it more expensive to do anything. And then in the US, you've got this big outflow since the credit crisis. There's been the monetary base has gone up about 2.5-fold. It was 1.6 trillion, and now it's at 4 trillion. That is starting to come off, which, as one person put it to me the other week, that is essentially a flow of money going from the banks to Main Street. So people are going to start spending that money as that curve comes down. We saw it in the 2016, it dipped down and inflation picked up at the same time. So as it comes off again, I think we've got these extraneous factors that could end up driving inflation. And it's not so much that the central bank don't want to act. The central bank are going to have to act, lest you end up with inflation running at, close on double digits, which is obviously contrary to their stated aim, with both the Bank of England and the Fed set to keep inflation at 2%.
My impression with some of these flows is that it is the fact that base rates are so low, and also some investors are just taking risk off the table from the equity market, and that's why they're looking at more in the area of real assets or high yield investments.
Yeah.
I think that's why they're doing it.
The point to remember with these corporate bonds is, yes, they can pay the coupon now, but when that comes to maturity, if they're looking to roll that into another another debt instrument, well, potentially what's paying 5% now will be having to yield 10% when they come to refinance, or maybe 12%. Will the market tolerate that from that business? And then you run the risk of the underlying, the coupon's great, but what's the underlying bond going to be worth at maturity? And I just think that's the longer term picture, that in much the same way as the housing market in the UK, I dread to think what's going to happen to it when interest rates tick up, because there are people that have owned property for 10, 12 years and have known nothing but these ultra low interest rates.
Well, this is the $64,000 question, isn't it? Because, you and I are young enough to remember higher interest rates, much, much higher interest rates in the UK. And we've seen them cut to virtually zero. And you look around at, as you say, in the UK housing market, can most borrowers tolerate UK base rates at, say, 5%?
Yeah.
And it wasn't that long ago,
No, it's in the late 90s. Early noughties, when I bought my first property, I remember that was 5%. If I recall right, it was 5%. It went up to about 6.5%. And yes, you noticed it because it was but that 5 to 6% move is a 20% move in the interest payments. What we're looking at now is it going from 1.25 to say 2.5, and that's a 100% move in that. That repayment amount, and it's I think you're right.
I don't know. This is these are one of the great what ifs of the financial markets. Can the UK housing market even tolerate, an increase of that level? That's probably what's keeping Mark Carney awake at night. Ultimately. One other thing I wanted to touch on was it's something we've been kicking around a lot actually on the Armchair Trader, and if you go and have a look, there's several articles about it over the last 6 months, is the whole UK retail market and UK retail stocks, and it's something a lot of analysts have looked at on a regular basis. I only mention this because of Debenhams this morning having restructuring of its debt, and at 1 minute it's looked like we were about to say goodbye to Debenhams as a presence on the UK high street, and now it looks like they're potentially back in business for a few more months. Everybody seemed to be going into Christmas. We were expecting that a lot of retailers would come out with some horrific numbers, including the supermarkets, and then Tesco came out with some better than expected numbers, and some of the retail stocks actually bounced in January and staged a bit of a rally. We were quite surprised by that because we were expecting, in some of the discussions we were having back in November, that there would be absolute carnage on the high street. Do you think that this is that we're seeing a sustainable support level for UK retail stocks, or is it going to be more bad news?
Sadly not. I think it's more bad news, especially for the generalists. The niche players are doing very well. We see that amongst the the fashion brands, the luxury brands. They're doing well. Also, if you look at the performance of the shopping centre operators, I think this is a good benchmark as well. The ones that are doing well are the ones that have gone after the leisure sector, have gone after the those small boutique type brands. The stuff you're not going to be able to buy on Amazon. If you want just a bog standard T-shirt, well, why pay £8 in Topshop when you can pay £2 on Amazon? Well, you can probably get 4 of them for £8 on Amazon, and sort of, or spend £10 and the delivery's free, whatever. I think that's where the big crunch is gonna come. We saw that there was that shopping centre sold in Scotland for the princely sum of £300,000. Last week or the week before, so that's about the cost of 2 average houses in Fife, or 40% of an average property in central London. Yes, it's going to be knocked down and rebuilt, but I think it just illustrates the fact that the market has changed so significantly. What you're seeing now is a string of renegotiations over rents that are being paid, because especially the likes of Mike Ashley, he's got so much clout now in that space. He can say to the landlords, well, you can either have something or you can have nothing. What you're not going to be able to get is what we've agreed to, or what's been agreed to in the contract, because that just doesn't stack up anymore. The model no longer works like that. So I think that's that's an interesting development, and the interest, you mentioned that Debenhams note this morning. One thing that jumped out at me in that is the financing rate didn't seem too bad, 5% over LIBOR, but that can be dialed up in the second quarter, and certainly the reading of the note that I saw had no detail of how or why that would be dialed up in Q2. So compared to, it was Cartwright about a year ago had to arrange some interim debt financing, and that rate that Debenhams got looked comparatively attractive to what they paid. I seem to remember there was a massive arrangement fee, and then high coupon on the debt over a fairly short period. I mean, Cartwright have survived to fight another year, but it makes me wonder what could that mean for Debenhams in the longer term. I think obviously the high street plays a very important part in the UK economy in terms of, it employs people, it has a social benefit. Yes, it's quite nice to be able to, when I can't be bothered to wait for Amazon or wait for the package to be delivered, to be able to jump in the car or get on the bus and go to my nearest high street and buy whatever I need. But the model is. I think the model's changing, and I think there's more bad news to come if we've seen an uptick now. It's only temporary.
I think you touched on it there. Online is obviously the a key part of the retail sector, and it strikes me that the businesses that have sort of got their act together, through online sales, are generally tending to sort of fare a little bit better than those that haven't. What do you think? I get the likes of ASOS have come up with they're having a few problems at the moment.
Yeah.
But generally, obviously, you look at the Amazon
I think there's another interesting point there in terms of what's happened with Ocado just in the last week or so down in their Hampshire distribution plant. That's going to have a big impact on sales. Now we've seen this with, I'm sure it was ASOS as well, where they had a fire in a distribution centre a couple of years ago, and there does seem to be some concentration risk in these businesses. Yes, they can overcome it, or it would appear that in the majority of instances they can overcome it. But again, perhaps it does suggest that that very centralised operation isn't quite the silver bullet that some people might like to think. Sports Direct, as far as I'm aware, have everything in that Shirebrook centre. It's the size of a small town by all accounts.
Yeah.
But that if anything was to happen there, then what would happen to their operation? So it's I think there is that there's a definite concentration risk there that we've started to see, but all of a sudden I wonder if actually you see a whole series of those coming up. What would be the takeaway for that?
No, I can see that. So, anything else going on in the world of broking, Tony, that our listeners might be interested in?
What are we seeing? We're seeing in terms of the the leveraged day trading market, people trying to innovate off the wake of really the ESMA restrictions that have cut those leverage levels. People making concerted efforts to better educate clients. One broker I'm aware of at the minute, Australian firm called Armchair Trader. They've got an FCA licensed arm running out of London. So they've got a utility called Psyquation it's a partner company of theirs, and that provides feedback on every trade that you place. So they're looking to not only at was the trade profitable, but they're looking at how frequently you're trading, how many instruments are you trading across. It's trying to actually trying to reduce the risk, I think, of how people are trading. I think that's a classic innovation we're going to see more of. Those risk warnings are laid bare now. How many people are losing money? I think they're all going to try. All the brokers are going to try and make efforts to get that at or below 50%. And obviously, the important thing to remember is that's going to be some kind of bell curve distribution. So you're not going to have to move that centre line all that far in one direction to have the ability to bring that number down quite sharply. A lot of people are losing money, but are only losing a relatively small amount of money, £20, £50, £100, and obviously that's counting as a loss-making client in the same way as someone who's lost £1,000 or £10,000 does. So I think those, that desire to find some marginal improvement is going to be seen wider across the industry. It'll be interesting to see what other brokers come out with.
Do you think that actual traders are looking closely at those numbers and say comparing brokers on the basis of that loss-making percentage that ESMA is making them disclose?
I think you need to be careful about that, because if you have a very small number of clients, there's one broker I won't name who I know has a very small number of clients, and they've got a really low percentage figure because those clients they've got are clearly professional, semi-professional traders, know what they're doing, managing their risk properly, and the bulk of them are consistently making money. I think when it comes to the biggest players, people will look at it, and you probably should look at it, because if you have a fully commoditized arrangement where you've got 10,000 traders with 3 or 4 brokers, if there's a 5 or 10% difference between two of those figures, you probably want to find out why. Is someone actually providing better execution? is someone providing better support? You know, is the pricing consistently tighter with one rather than the other? And it's all well and good people screaming about their tightest spreads or their average spreads, but I think that starts to become the, you know, if one person's showing 80% and one's showing 70%, I think it's worth closer, you know, some closer inspection. And it wouldn't surprise me if we start seeing that appear as a reference point for the, you know, as an index of how the big traders are, how the big brokers are mapping out in the future. I think getting that rate lower not only helps from a marketing message, but also does say something about how the business is working.
So, do we think that the ESMA regulations and things are helping to improve the perception of the industry for traders themselves? I don't know. I think the big risk is it's driving people from a regulated environment to an unregulated environment. There are groups of traders who benefit or who run strategies that require high leverage. People that are probably following largely algorithmic-based trading systems. So the important thing about that is they're taking the emotion out of it. They're not staring at a screen with flashing lights and a news feed and suddenly going, I'm going to buy there, I'm going to sell there, and getting carried away with it. These guys have plugged software into their MT4 platforms and they're just running, and they require the high leverage. So what you're seeing there is brokers make efforts to register offshore. And I mean, this is nothing new. Isle of Man, Belize, stuff like that has happened for ages. But some of the offshore entities are becoming more diligent and realise they can provide a viable alternative. I was talking to a chap who just regulated an entity in the Cook Islands, and he said the process for doing it was absolutely, you know, it was so labour intensive. The amount of documentation they had to show, they've had to open a physical office, they've had to employ 5 or 6 people locally. So the regulator is laying down stringent guidelines here, and he's saying that people want the ability to get this high leverage. Forcing them to either try and convince a broker that they're professional or put them onto 30-to-1 leverage doesn't work for them. They need the 200-to-1 leverage that was out there. They're just looking to scalp the market, pick off a couple of pips at a time, and we have to we're offering them that solution. But there is the bigger situation. Do you have rogue operators come in and people start trading with them and they're completely out with the protections of the FCA?
So thank you very much indeed for that, Tony. That's been really insightful, and thanks very much for coming in to talk to us today.
You're welcome.
You've been listening to the Armchair Trader podcast. Be sure to pop by our website, thearmchairtrader.com, for regular daily updates on trading, investment and financial markets around the world.